The dominoes have started falling. For decades, we have watched Japan conduct the most reckless monetary experiment in human history. We have watched the Bank of Japan print trillions of yen to buy government bonds that nobody else wanted. We have watched them suppress interest rates to zero, to negative, to levels that made a mockery of every principle of sound money. We have watched them enable a government debt burden that now exceeds 260% of GDP, a number so absurd that economists had to invent new models just to pretend it was sustainable. We have watched, and we have warned. We have said that one day the experiment would end. We have said that one day the math would catch up. We have said that when Japan breaks, it will not break quietly. It will send a shockwave through the global financial system that will liquidate portfolios, collapse banks, and force a repricing of every asset on Earth. But that was just a theory. That was just a projection based on historical patterns and mathematical inevitabilities. We did not have the smoking gun. We did not have the trigger event. We did not have the date. Until now. Stop speculating. Stop wondering. Because the trigger has been pulled, Japan has just initiated a policy shift that will unwind $20 trillion in leveraged positions within the next 90 days. Your portfolio is in the blast radius. Your retirement account is in the blast radius. Your bank deposits are in the blast radius. Welcome to Vault Zero. The 90-day countdown has begun. Let me show you exactly what just happened and exactly what you need to do before the liquidation wave arrives. Before we dissect the trigger event, you need to understand the architecture of the bomb that Japan has been building for 30 years. This is not a simple story of government overspending. This is a story of the most elaborate financial engineering scheme ever constructed. A scheme designed to allow a nation to borrow without limit, spend without consequence, and defer the reckoning indefinitely. The scheme worked brilliantly for 3 decades. But the scheme has a fatal flaw. It requires interest rates to stay at zero forever, and forever just ended. Here is how the scheme worked. The Japanese government needed to borrow money to fund its budget deficits. Normally, when a government borrows too much, the interest rate on its bonds rises to reflect the increased risk. Higher interest rates mean higher borrowing costs, which forces the government to reduce spending or raise taxes. This is the natural discipline of the bond market. But Japan did not want discipline. Japan wanted to borrow without limit while paying almost nothing in interest. So they deployed the Bank of Japan as the buyer of first, last, and only resort. The BOJ printed yen and used it to buy Japanese government bonds, JGBs, in quantities so massive that they now own over 50% of the entire market. When you own half the market and you are willing to buy unlimited quantities, you control the price. And when you control the price of bonds, you control the interest rate. For years, the BOJ held the 10-year JGB yield at or below 0.5% through a policy called yield curve control. They drew a line in the sand and defended it with infinite money printing. Borrow all you want, they told the government. We will make sure your interest expense stays near zero. It was financial alchemy. It was debt monetization on a scale never before attempted, and it created the conditions for the explosion we are now witnessing. The problem with infinite money printing is that it destroys your currency. The yen has been in a death spiral for the past 3 years. It has fallen from 110 to the dollar to over 160 to the dollar, losing nearly 35% of its value against the world's reserve currency. For Japanese citizens, this means that everything they import costs 35% more. Energy costs more. Food costs more. Raw materials cost more. Inflation, which Japan spent 20 years trying to create through monetary stimulus, has finally arrived with a vengeance. But this inflation was not caused by economic strength. It was caused by currency collapse. The BOJ is trapped. If they continue printing yen to suppress bond yields, the currency will crash further, inflation will accelerate, and the Japanese people will see their purchasing power destroyed. But if they stop printing and allow bond yields to rise, the government's interest expense explodes. The bond market collapses, and the banks that hold JGBs face catastrophic losses. There is no good option. There is only a choice between disasters. And last week, the Bank of Japan made its choice. They chose to stop defending the yield curve. They chose to let interest rates rise. They chose to save the currency at the expense of the bond market. And in making this choice, they lit the fuse on a $20 trillion bomb that is now hurtling toward the global financial system. Let me explain the specific policy change because the details matter enormously. For years, the BOJ maintained yield curve control by committing to buy unlimited JGBs at a yield of 0.5%. If the market tried to push yields above that level, The BOJ would step in and buy every bond offered until the yield was pushed back down. This was an unconditional commitment. It was a line that could not be crossed. But last week, the BOJ announced that they are widening the YCC band to 1.0%, and more importantly, that they will treat the new ceiling as a loose reference rather than a hard cap. In central bank speak, this means they are abandoning the defense. They are telling the market that yields can now rise without triggering infinite intervention. They are stepping back from the printing press. And the market is responding exactly as you would expect. JGB yields spiked immediately. The 10-year yield, which had been pinned at 0.5%, jumped above 0.9% within days. The 30-year yield, which had been anchored around 1.5%, surged above 2.2%. These might seem like small numbers if you are used to watching U.S. Treasury yields, but in the context of the Japanese bond market, these moves are seismic. A 40 basis point rise in the 10-year yield might not sound dramatic, but when applied to a market worth over $10 trillion, it translates to hundreds of billions of dollars in losses for bondholders. And the losses are just beginning. Now I need to connect this to the $20 trillion figure, because this is where the local Japanese story becomes a global extinction event. The Japanese financial system does not exist in isolation. It is interconnected with every major financial market on Earth through a mechanism called the carry trade. The carry trade is elegant in its simplicity and catastrophic in its consequences. Here is how it works. For 30 years, Japan has maintained the lowest interest rates in the developed world. In many years, Japanese rates were actually negative. If you were a global hedge fund, a multinational corporation, or an institutional investor, you could borrow yen at essentially zero cost. You would then convert that borrowed yen into dollars, euros, or other currencies and invest the proceeds in higher-yielding assets. Buy U.S. Treasury bonds paying 4%. Buy U.S. corporate bonds paying 6%. Buy U.S. stocks returning 10%. Buy emerging market debt paying 8%. As long as the yen stayed weak or stable, you earned the spread between your zero-cost borrowing and your higher-yielding investments. It was free money. It was a perpetual motion machine of financial returns. And over 30 years, trillions upon trillions of dollars worth of these carry trades accumulated. The Bank for International Settlements estimates that the gross notional value of yen-denominated carry trades exceeds $20 trillion. $20 trillion in leveraged positions that depend on two conditions remaining true. First, Japanese interest rates must stay near zero. Second, the yen must not strengthen significantly against other currencies. Both conditions are now failing simultaneously. When the BOJ abandoned yield curve control, they triggered a violent rally in the yen. Currency traders understand that higher interest rates make a currency more attractive. If Japanese rates are rising while American rates are stable or falling, money flows toward Japan. The yen strengthens. And when the yen strengthens, the carry trade goes into reverse. Think about what happens to a hedge fund that borrowed yen at 155 to the dollar to buy U.S. stocks. If the yen strengthens to 140, the fund now needs more dollars to repay the yen-denominated loan. The investment might still be profitable, but the currency loss eats into the gains. If the yen strengthens to 130, the currency loss might exceed the investment gain. The trade becomes unprofitable. The fund needs to exit, and exiting means selling the U.S. stocks, converting the dollars back to yen, and repaying the loan. Now multiply this dynamic across $20 trillion in positions. When the carry trade unwinds, it creates a cascade. The selling of U.S. assets pushes American markets down. The buying of yen pushes the yen higher. The stronger yen increases the losses on remaining carry trades, which forces more selling. The more selling, the stronger the yen. The stronger the yen, the more selling. It is a feedback loop that feeds on itself until the entire $20 trillion edifice is liquidated. This is not a theoretical risk. This is a mathematical certainty. The carry trade must unwind because the conditions that supported it are ending. The only question is how fast and how violently. Let me show you the timeline because understanding the 90-day window is essential for protecting yourself. The unwinding of the carry trade does not happen overnight. Large institutional positions cannot be liquidated in a day without moving markets catastrophically. The hedge funds and asset managers holding these positions will attempt to exit in an orderly fashion, selling gradually to avoid triggering a panic. But there is a problem. When everyone heads for the exit at the same time, orderly becomes impossible. The Bank of Japan's next policy meeting is in 6 weeks. The market expects further tightening. The market expects another rate hike or another widening of the yield curve band. Each meeting is a potential trigger for accelerated unwinding. The U.S. Federal Reserve meets in 7 weeks and again in 10 weeks. If the Fed signals that U.S. rates have peaked or will be cut, the interest rate differential between Japan and the U.S. narrows further. The carry trade becomes less profitable. More positions must be closed. The Japanese government's fiscal year ends in late March, approximately 90 days from now. Japanese institutional investors, pension funds, and insurance companies will be rebalancing their portfolios. They will be selling foreign assets and repatriating yen to window dress their balance sheets. This seasonal flow compounds the carry trade, unwinding. It creates a wall of selling that will hit global markets precisely when the carry trade liquidation is accelerating. The 90-day window is not arbitrary. It is the intersection of these three forces. Rising Japanese rates driving yen strength. Global investors unwinding carry trades to avoid losses. Japanese institutions repatriating capital for fiscal year-end. These forces will converge in the first quarter of the next year. They will hit simultaneously, and the impact on your portfolio will be devastating if you are not prepared. Let me quantify the damage, because abstract warnings are not sufficient. The carry trade unwinding will trigger forced selling of approximately $3 to $5 trillion in U.S. assets over the 90-day window. This includes Treasury bonds, corporate bonds, and equities. The selling will not be distributed evenly. It will concentrate in the most liquid assets because those are the easiest to sell quickly. Large-cap U.S. stocks will be hit first. Treasury bonds will be hit simultaneously. The assets that investors consider safest and most liquid will experience the most violent declines, because that is where the carry trade money is parked. A $3 trillion liquidation in a market that trades $500 billion per day might seem manageable, but the marginal seller sets the price. When there is a wall of selling and no corresponding wall of buying, prices gap down. The circuit breakers trigger. Trading halts. When trading resumes, prices gap down again. This is what happened in March 2020 when the Treasury market itself seized up. This is what happened in the 1987 crash when portfolio insurance triggered a cascade of selling. The carry trade unwinding is the same dynamic at a larger scale. Now I need to explain why the Federal Reserve cannot save you this time, because this is the assumption that will destroy unprepared investors. For 15 years, investors have been conditioned to believe in the Fed put. When markets crash, the Fed cuts rates, prints money, and rescues asset prices. This conditioning has made investors complacent. It has made them believe that downside risk is limited because the central bank will always intervene. But the Fed put only works when inflation is low. When inflation is running at 4% or 5%, the Fed cannot cut rates aggressively without reigniting the inflationary fire they spent 2 years trying to extinguish. When foreign investors are already fleeing dollar assets due to de-dollarization, the Fed cannot print trillions without triggering a currency crisis of their own. The Fed is trapped. They cannot lower rates because inflation is still above target. They cannot print money because the dollar is already under pressure from BRICS alternatives. They cannot rescue the stock market without sacrificing the bond market and the currency. For the first time in 40 years, the Fed put is broken. Investors who are waiting for the Fed to save them will be waiting while their portfolios are liquidated. The rescue is not coming. The cavalry is stuck. And the carry trade unwinding will proceed without central bank intervention to cushion the blow. Let me address the impact on the U.S. Treasury market specifically because this is where the crisis becomes existential. Japan is the largest foreign holder of U.S. Treasury bonds. As of the latest data, Japanese investors hold approximately $1.1 trillion in treasuries. When the carry trade unwinds, when Japanese institutions repatriate capital, when the BOJ's policy shift strengthens the yen, these treasury holdings will be sold. But Japan is not alone. China holds $800 billion in treasuries and has been steadily reducing its holdings for years. Middle Eastern sovereigns hold hundreds of billions and are diversifying away from dollars. European institutions are rebalancing toward domestic assets. The marginal buyer of treasuries is disappearing precisely as the largest sellers are preparing to dump. The U.S. government is running a $2 trillion annual deficit. It must issue $2 trillion in new treasury bonds every year just to fund the gap between spending and revenue. When foreign buyers are selling rather than buying, who absorbs the new issuance? The domestic buyers are tapped out. The pension funds are overweight bonds. The insurance companies have reached their allocation limits. The only remaining buyer of size is the Federal Reserve itself. But if the Fed buys treasuries through quantitative easing, it is printing money, which is inflationary, which is the opposite of their stated policy goal. The Treasury market is facing a buyer's strike at the same moment it faces a wall of selling. When supply exceeds demand, prices fall. When bond prices fall, yields rise. When Treasury yields rise, the government's interest expense increases. The deficit widens, more issuance is required, more selling pressure accumulates, the doom loop accelerates. The 10-year Treasury yield, which is currently around 4.5%, could easily spike to 6% or 7% during the carry trade unwind. Each 1% increase in Treasury yields destroys approximately $2 trillion in bond market value. A move from 4.5% to 6.5% would destroy $4 trillion. This destruction does not stay contained in the bond market, it cascades. Banks hold Treasury bonds as capital reserves. When the value of those bonds falls, the bank's capital ratios deteriorate. They must either raise new capital, which is expensive and dilutive, or reduce lending, which contracts the economy. Regional banks that loaded up on long-duration treasuries during the zero-rate era are particularly vulnerable. We already saw Silicon Valley Bank fail because of Treasury losses. The carry trade unwind will create a dozen SVBs. It will create a systemic banking crisis at the same moment it is creating a stock market crash. The crises will reinforce each other. The stock crash will destroy wealth, reduce spending, and push the economy into recession. The banking crisis will freeze credit, prevent refinancing, and trigger corporate defaults. The Treasury crisis will raise government borrowing costs, widen deficits, and undermine confidence in the dollar itself. These are not three separate crises. They are one crisis with three manifestations, and Japan just triggered all of them simultaneously. Now let us discuss the silver dimension, because precious metals are the only asset class that benefits from this scenario. When stocks crash, bonds crash, and currencies crash simultaneously, the traditional diversification models fail. The 60-40 portfolio fails. The risk parity models fail. Every asset that exists within the financial system is a claim on a counterparty that might not survive the crisis. But physical precious metals are not claims. They are assets. They have no counterparty risk. They cannot default. They cannot be inflated away. They cannot be frozen by a government or closed by an exchange. When the carry trade unwinds and $20 trillion in leveraged positions are liquidated, the money has to go somewhere. Some of it will go into cash temporarily. But cash in dollars is losing value to inflation. Cash in yen is appreciating, which is good for Japanese holders but bad for everyone else who needs to convert. Cash in euros is subject to the European banking crisis. There is no safe cash. There is only the illusion of safety. The money that seeks true safety, permanent safety, generational safety, will flow into gold and silver. And because the precious metals markets are tiny relative to the ocean of capital seeking shelter, the prices will explode. Silver specifically is positioned for the largest gains because of its unique combination of monetary and industrial properties. The carry trade unwind will trigger a recession. Recessions normally reduce industrial demand for commodities. But silver's industrial demand is increasingly recession-resistant. Solar panel production is mandated by government policy and subsidized regardless of economic conditions. Electric vehicle production is accelerating globally as manufacturers shift away from internal combustion. Military and aerospace demand is increasing as geopolitical tensions escalate. The green energy transition is not optional. It is a policy imperative that will proceed regardless of recession. Silver demand will not fall during this crisis. It will continue to grow even as the financial system contracts. Meanwhile, the investment demand for silver will explode. The carry trade unwind will trigger a flight to safety. Gold will absorb much of this flow, but silver offers higher percentage returns because of its smaller market size. The gold market is worth approximately $12 trillion. The silver market is worth approximately $60 billion. When the same wall of money hits both markets, silver moves 200 times faster. A $10 billion inflow into gold moves the price 0.1%. A $10 billion inflow into silver moves the price 16%. This is why silver historically outperforms gold during monetary crises. It is the smaller boat on the same wave, and the wave that is coming from the carry trade unwind is larger than any wave since the 1970s. Let me give you the specific price projection, because you need to understand the magnitude of the opportunity. If just 5% of the $20 trillion in carry trade positions liquidates into precious metals, that is $1 trillion seeking exposure. The entire investable silver market, every ounce of above-ground silver available for investment, is worth approximately $60 billion at current prices. $1 trillion trying to fit into a $60 billion market requires the price to multiply by a factor of 17. That would take silver from $80 to over $1,300 per ounce. This is not a typo, this is arithmetic. Now, in reality, not all of that money will flow into silver. Some will flow into gold. Some will flow into other real assets. Some will be lost in the crash rather than reallocated. A more conservative assumption is that 1% of the carry trade, $200 billion, flows into precious metals, with 10% of that $20 billion specifically targeting silver. A $20 billion inflow into a $60 billion market requires the price to increase by 33%. Silver goes from $80 to $106 just from that single source of demand. But this ignores the concurrent short squeeze on the COMEX, the industrial deficit that is draining stockpiles, and the safe haven demand from retail investors who are watching their portfolios disintegrate. Layer all of these demands together, and $150 silver becomes conservative. $200 silver becomes realistic. $300 silver becomes possible if the crisis is severe and prolonged. The 90-day window is the countdown to this repricing event. What should you do with this information? The answer depends on your current positioning, but the principles are universal. First, assess your exposure to the assets that will be liquidated. If you hold U.S. stocks in a taxable brokerage account, understand that these will be sold by the carry trade unwind. The selling will not discriminate between good companies and bad companies. Everything gets sold when leverage unwinds. The question is whether you want to be selling alongside the forced liquidators, getting whatever price the market offers, or whether you want to reduce your exposure now, on your terms, at current prices. I am not telling you to sell all your stocks. I am telling you to understand the risk and position accordingly. Reduce exposure to the most vulnerable sectors, increase cash reserves, and most importantly, allocate a meaningful portion of your portfolio to assets that will appreciate during the crisis rather than depreciate. Second, examine your bond holdings. If you hold Treasury bonds, Treasury ETFs, or bond funds of any kind, understand that the carry trade unwind will push yields higher and prices lower. Long-duration bonds will be hit hardest. The 30-year Treasury could lose 20% to 30% of its value if yields spike from 4.5% to 6.5%. Bond funds that are forced to mark-to-market will show these losses immediately. Individual bondholders can hold to maturity and pretend the losses do not exist, but they will not be able to sell at par if they need liquidity. The assumption that bonds are safe is about to be shattered. Reduce duration. Consider short-term instruments if you must hold fixed income. Or better yet, reallocate to assets that benefit from rising rates and rising inflation, assets like silver that are tangible, finite, and outside the credit system entirely. Third, accumulate physical precious metals immediately. Not paper representations, not ETF shares, not futures contracts, physical metal that you control. The 90-day window is a gift. It is advance warning of a crisis that will make physical metal unobtainable. When the carry trade unwind triggers the stock crash, when the banking crisis intensifies, when the Treasury market seizes, every investor on Earth will be trying to buy gold and silver simultaneously. The dealers will be overwhelmed. The mints will be backordered. The premiums will spike to 50%, 75%, 100% over spot. The metal will simply be unavailable at any price. This has happened before. It happened in 2008. It happened in 2020. And it will happen again with even greater intensity during the coming crisis. Buy now while the metal is available. Buy now while the premiums are reasonable. Buy now while the 90 days you have left are still counting down. When the clock hits zero, the opportunity closes. Fourth, prepare for the secondary effects of the crisis. A $20 trillion liquidation will not be a financial event in isolation. It will trigger recession, unemployment, corporate bankruptcies, and political upheaval. The social fabric will strain. The government will respond with emergency measures that may include capital controls, withdrawal limits, or asset seizures. Having physical metal outside the banking system is not just about price appreciation. It is about having resources that cannot be frozen, seized, or inflated away. It is about maintaining optionality when the system itself is failing. Gold and silver have served this purpose for 5,000 years. They will serve it again during the crisis that Japan has just triggered. The Bank of Japan tried to thread an impossible needle. They tried to suppress rates forever while maintaining a stable currency. They tried to have infinite money printing without infinite consequences. The needle has slipped, the thread has snapped, the consequences are arriving with compound interest after 30 years of accumulation. The yen carry trade, the largest leveraged bet in financial history, is unwinding. The $20 trillion in positions that depended on Japanese rates staying at zero are being liquidated. The selling pressure will hit U.S. stocks, U.S. bonds, and global markets simultaneously. The buyers who are supposed to absorb the selling are absent. The central banks that are supposed to rescue the markets are trapped by inflation. The portfolio that you built over decades of saving and investing is in the blast radius. You have 90 days. Maybe less if the BOJ accelerates its tightening, maybe more if the process is drawn out. But the direction is certain. The liquidation is coming. The only variable is whether you are positioned to survive it or be destroyed by it. I am Vault Zero. This is the breakdown. Japan has triggered a $20 trillion crisis. Your portfolio has 90 days before the liquidation wave arrives. The yen carry trade is unwinding. The Treasury market is facing a buyer's strike. The stock market is facing forced selling. The banking system is facing another SVB moment. And silver is facing the largest supply-demand imbalance in modern history. The next 90 days will determine who emerges from this crisis with their wealth intact, and who watches their life savings evaporate in a cascade of margin calls and forced liquidation. The time to prepare is now. The time to act is now. The time to move your wealth outside the system is now. When the 90 days are over, when the crisis is upon us, when the screens are flashing red and the exchanges are halted, you will either have the mettle or you will have the regret. Choose wisely, stack accordingly, and I will see you in the vault when the storm passes. Like and subscribe to stay informed. Share this with someone who still trusts the system. And remember, the countdown has started. 90 days, the clock is ticking. Protect yourself, protect your family, and get ready for the greatest wealth transfer in modern history. The dominoes are falling. Japan was the first. Your portfolio might be next, unless you move it out of the way. See you in the vault.